Ladies and gentlemen, welcome back. In this video, we are going to discuss working capital. This is an area of key focus by financial analysts and therefore a driver of how the marketplace judges a company's performance and how they value its share price. This will explore some of the finer points of financial analysis, but any savvy investor needs to have a basic understanding of how broker analysts view and evaluate a company's performance and future outlook. Working capital is current assets less current liabilities. Analysts expect a company's current assets, cash plus inventory plus accounts receivable, to exceed its current liabilities, which are accounts payable and other short-term debt, including the current portion of long-term debt payments due. Analysts look for a ratio of somewhat above 1.0, usually less than 2.0. This ability to meet short-term obligations is referred to as liquidity. An excessively high score is indicative of inefficiency. They have too much of their money invested in inventory or are being inefficient in collecting their receivables. Keep in mind, receivables is the amount you have in essence loaned to customers in the form of sales on credit. This has to be managed by the company. Working capital is especially important to credits and lenders. That is because it is a measure of the company's ability to meet its short-term obligations to sustain operations such as paying salaries, rent, supplies, and etc. Working capital assessment does vary by industry. Think about it. Companies that have a lot of fixed assets financed, such as heavy manufacturing or mining companies, for example, need to have greater liquidity than a service business such as a retailer that invests primarily in short-term inventory to resell. As mentioned, working capital is the difference between current assets and current liabilities. Inventory is one of the key components of the current assets part of the working capital. As an investor, it is important for you to understand how the company is accounting for their inventory costs. It is important because it impacts their gross profit margin. Now think about this. If a company has inventory in the warehouse, some of which was purchased last year and some this year at higher prices, what do I report as the cost of goods sold, or COGS? Remember how gross profit is determined. It is net sales less cost of goods sold. The difference is gross profit, and gross profit is divided by net sales is the gross profit margin. Here's an example from a hypothetical manufacturing company. These two examples show the same sales, but different gross profit and different gross profit margins, which are gross profit divided by net sales once again. If they were different companies, you might think B was a more efficient operator than A because of the higher absolute profit and higher profit margin. But they are the same company, selling exactly the same products. The only difference is the accounting method. The A column shows raw material at the most recent price paid, and column B shows the cost of raw material at the price paid last year, which is correct. Both are correct, just different accounting, and both are considered legitimate and acceptable accounting methods. Column A is using the LIFO accounting method. This is the last in, first out accounting method in pricing its raw material inventories. Column B is using the FIFO accounting method. This is the first in, first out method. Thus, FIFO will transfer value from the inventory account on the balance sheet to the cost of goods sold on the income statement based on the prices paid for the oldest inventory first. What are the implications to you, the investor? It is important to understand that in a period of rising prices, the LIFO method will assign higher prices to inventories. That means the cost of goods, or the cost of sales on the income statement will be higher and the profits lower. Therefore, it is more conservative. Also, in these circumstances, the LIFO method will understate the current value of inventories on the balance sheet. The company is required to inform you if they are using the last in, first out accounting method, so look for those footnotes we talked about. Another measure of operating efficiency is to compare the company's inventory turnover rate to other companies in its industry. Inventory turnover is a simple calculation. It is net sales divided by inventory. As the name implies, it provides insight into how much money the company's management is tying up in inventory relative to the sales. An uncommonly high turnover rate is indicative of a high sales rate, while an uncommonly low turnover rate indicates a lower than expected sales rate or ineffective purchasing resulting in carrying too much inventory relative to sales. By comparing the company with others in its industry, you can assess what the norm is for companies in the same business and view the turnover rate relative to that. Accounts receivable are another key component of the current assets part of working capital. Accounts receivable are the amount owed to the company by customers that have purchased on credit. Thus, receivables consumer working capital like loans, which they essentially are to its customers in the form of delayed payment like a credit card. A well-managed company seeks to efficiently manage both accounts receivable and inventory, since they are both representing investments the company has financed through borrowed or shareholder investment. Thus, another measure of operating efficiency is receivables turnover ratio. Calculating receivables turnover is similar to inventory turnover. It is net sales divided by accounts receivable. This ratio provides insight into how effectively the company extends and collects the credit it extends to the customers in the form of accounts receivable. And like inventory turnover, it is best viewed in light of how their receivable turnovers compare with other companies in the same or similar business. Turnover ratios, whether they are inventory turnover or receivables turnover, are not meaningful in isolation. They are most useful when compared to other companies. So look up your company's competitors and compare your company's turnover ratios with theirs. Investigate further if they vary widely. Let's look at two well-known competing companies, Walmart and Target. They vary greatly in size and number of stores, but they both discount variety retailers and sell the same sorts of merchandise, including groceries. We do know some things about Walmart just by reputation alone. Walmart is very aggressive on low prices, and they achieve this by aggressive purchasing and aggressive cost containment, especially when it does come to inventory management. Their efficiency in warehousing and inventory management is legendary in American business. Let's see how these two companies compare in the 12 months ending in January of 2012. They are both big companies, but Walmart dwarfs Target. They outsell Target by 6 to 1. That's 447 billion versus 70 billion. Gross profit margin, however, is comparable, 25% versus 31.5%. Walmart is a little lower, reflecting their focus on low prices. Look at the turnover ratios. Here we see a big difference. First, the amount of cash tied up in receivables is surprisingly comparable, about 6 billion each. That yields a huge advantage to Walmart due to its much larger sales base. Their accounts receivable turnover ratio is a whopping 75.28 versus Target's 11.79. For its size, Walmart carries a surprisingly small amount of receivables. Walmart's amount of inventory is much larger than Target's, reflecting its larger store and sales base. However, look at how close the inventory turnover ratios are to each other. Walmart's is actually higher, at 10.98, than is Target's at 8.82. That demonstrates Walmart's proficiency at managing its purchasing, warehousing, and throughput to its stores. Walmart's legendary reputation for cash and inventory management is clearly demonstrated by these comparisons. To conclude this video, the analysis of working capital informs you about the operational efficiency of the company and its management and the company's ability to meet its short-term obligations. It also provides you insight into how professional brokerage house analysts view the company and its future outlook. This gives you knowledge, and knowledge is power in the investing world. Make sure you have and that you understand your investment goals, your plan, and then choose your investment carefully and prudently in keeping with that plan and with the knowledge you gain from these videos. Thanks once again for joining me.